What if I told you that you could trade without that constant, nagging fear of losing money? I know, it sounds almost too good to be true, right? Well, today we're going to break down a strategic blueprint designed for 2025 that claims to do exactly that. All right, let's kick things off with the one question that I know is on every single trader's mind. Trading me a loss pagkahe. Is losing money just an unavoidable part of the game that we all have to stomach? Well, according to this framework we're looking at today, the answer might actually be no. It lays out a potential escape route, a way to navigate the market's chaos by changing the game completely. So, what's the secret sauce here? The whole thing really boils down to one crucial shift in your thinking. Stop trying to guess where the market is going and start engineering the outcome you want from the get-go. Think of it like this. Most of us are probability traders. We're looking at charts, we're looking at news, and we're basically placing a bet on the future. Structural trading? It couldn't care less about the future. Instead, it locks in a profit by taking advantage of the mathematical relationships that already exist right now between different prices. And this is the magic formula that makes it all possible. Put, call, parity. Seriously, think of it like a fundamental law of physics for the market. It's a mathematical guarantee that lets you combine different options in such a way that you create a totally predictable, fixed outcome, no matter what the market decides to do. Okay, but before we jump into the actual plays, we've got to understand the new rules of the playground. The market is getting a bit of a shakeup in late 2025, and knowing these changes is absolutely critical. So, the first big one is this. The Nifty Lot Size is shrinking from 75 down to 65. Now, that might sound like a small tweak, but for anyone holding long-term positions, it's a huge rebalancing headache. This isn't something you can just fix on the fly. You've got to plan for this months in advance. And here's where things get really tricky. This slide shows a hidden trap, something called the Securities Transaction Tax, or STT. That tax on an option that expires in the money, it's not on your little premium. It's on the entire intrinsic value. It can be so massive that it turns a great trade into a terrible loss. It's the silent portfolio killer. Okay, so with those new rules in mind, let's get into the 3 specific strategies the framework proposes. These are the 3 paths you can take to try and achieve that zero-loss outcome. First up, we have what's called the fortress collar. And honestly, the name says it all. The number one goal here is the absolute rock-solid preservation of your capital, while still giving it a chance to grow. So how do you build this fortress? It's a 3-step process. 1, you buy the underlying asset, in this case, the NiftyBees ETF. 2, you buy an insurance policy on that asset, which is your put option. And 3, you get someone else to pay for that insurance by selling a call option, which brings in a premium. And this is the beauty of it. Let's look at the outcomes. If the market tanks, you don't lose a single rupee. That put option acts like a perfect shield. And if the market rallies, okay, you don't capture all the upside, your profit is capped, but you still make a safe, predictable return. You're basically giving up lottery ticket-sized wins for the guarantee that your capital is 100% safe. All right, strategy number 2 is for a totally different mindset. This isn't about protecting a big portfolio. It's about being a sniper. This is the box spread, a pure arbitrage play designed to pick off small, guaranteed, and, risk-free profits from tiny market mispricings. The math here is just beautiful. You create a structure of options that costs you, say, 90 rupees to build. But you know with total mathematical certainty that it will be worth exactly 100 rupees at expiry. That 10 rupee gap, that's yours to keep. Locked in. No ifs, ands, or buts. But, and this is a huge but, there is one golden rule with this strategy. You absolutely cannot break it. If you do, you turn that sure thing into a total disaster. And here's that trap again. Remember that monster STT we talked about? Look at this. Your profit is this tiny little bar, right? But the potential STT cost, it's a giant. If you let the wrong leg expire in the money, that tax can be 10 times bigger than your profit. You have to get out before expiry, period. All right, that brings us to path number 3, the hedged iron fly. Now, this one is for the active traders, the folks who want to pull in consistent weekly income, but with a clearly defined risk, a built-in safety net. So the way it works is around 10 in the morning, you build this structure. You sell options right at the current market price, and then you buy other options further away to act as your hedges. It creates this kind of profit tent, where as long as the market just chills out and stays inside that range, you're making money. Now here's the catch. Unlike the Fortress, which is pretty much set it and forget it, this one is active. You gotta be at the wheel. It's all about firefighting. If the market makes a big move against you, you have to follow a strict set of rules, either by shifting the whole structure or changing the trade entirely.
Okay, so we've got 3 different paths, right? One for ultimate protection, one for quick arbitrage, and one for daily income. So, which one is the real zero-loss strategy?
Well, to figure that out, the framework does something smart. It asks, how do the big fish trade? What are the FIIs, the institutional giants, actually doing with their money? Because how they manage risk on a massive scale tells you a lot.
And you know what? The data tells a really interesting story. The big money, they're not just flipping a coin and betting on red or black. They're using all sorts of data, their own futures positions, the put-call ratio, to build these robust, hedged structures. They're not playing checkers. They're playing chess. And all of this brings us to the final, crystal clear conclusion. When you factor in the need for active management, when you factor in those hidden tax traps, the framework says the Fortress Caller is the only one that truly delivers on that promise of zero-loss capital protection. It's not really a trade, it's more like putting your money in a vault. And that really leaves us with one last big question to chew on. Are you trying to build a resilient long-term portfolio, or are you just placing bets? Because according to this entire framework, true, lasting safety in the market doesn't come from getting lucky on a guess. It comes from building a solid structure.